I mean, I think in its simplest form, we first of all look for an equity that we think is mispriced. We then try to identify the reason why it has become mispriced. And lastly, we try to identify a roadmap that we think will change that mispricing. So we use a whole variety of inputs, frankly, to identify that mispricing. Yes, we do use screening. We use company visits. You know, we have a team of people based here who are out on the road all the time visiting companies, getting feedback from corporate management on the state of the business. We obviously interact with the sell side, and they help us with their perception of value in Japan. We also use the sell side as a sounding board for our own perceptions, just to make sure that we're not missing something, or if we have a contrarian idea that it is generally contrarian, that the sell side is completely missing the point. So we're looking for margin change. I think operating leverage in Japan is usually misunderstood. So we're looking for companies that once generated a 7 or 8% margin, that perhaps for whatever reason have gone down to a 2% margin, which happen to look rather cheap even at a 2% margin, either on PE or EV to EBITDA, but which have a chance of getting back to half the way back to the peak margin. That could be restructuring, it could be a new product, it could be a new management team, it could be growth in an end market that is not being properly appreciated. So the dynamism of operating margins is something that I think is not well understood in Japan. Most companies here are highly cyclical. Many companies here are highly cyclical, and understanding how margins go up and down and how operating leverage goes up and down is something that I think is an important part of our toolkit, and that gives us an advantage in understanding mispricing. And then on the sort of cash flow and governance side of things, we're looking for change in balance sheet structure, return of cash to shareholders, higher dividend payout ratios, more understanding of the needs of minorities among the new management team. We're looking for restructuring of underperforming businesses. You find a lot of Japanese companies are still over-diversified. They may have a great core business, but it's being offset by legacy investments in very poor businesses that generate a very poor return on capital. For example, one of our big investments at the moment is a company called 7&I Holdings, which is the owner of the 7-Eleven chain in Japan, which is a convenience store chain. That's a great business in Japan. It doesn't require a lot of capital because it's run by franchisees, not by the listed company. It's a format that's taking a lot of market share in Japan. The return on investment is extremely high, and we love that business. But the company also operates a grocery chain and a department store chain, and those are much poorer businesses with much weaker return on capital. So there we're encouraged by the fact that they're restructuring those businesses. They're closing underperforming outlets. They're essentially pouring all of their new capex into the convenience store business. And over time, clearly the asset mix is going to change and the margin mix will change. And we think the market isn't recognizing that fact properly at the moment and is giving the company a multiple that reflects the past, not the future. So, there we expect both an improvement in margins and a re-rating of the stock. We're betting on a slight re-rating of the PE multiple as the business mix changes. So we think that's a growth company that has a top-line story and a margin story, and is just the wrong price and hasn't been properly discounted.